Good morning. Welcome to WAX Insights. This is another market update. Today is October 10th and we're pre-market. So we're going to start with the big picture first, how S&P 500 has performed, how gold has rallied to new highs, and where Bitcoin may go from here before we cover the chart analysis for macro assets, bonds, stocks, gold, Bitcoin, and the individual large cap names. All right, let's begin. S&P 500 year to date up 15%, almost 16%, hitting new all-time highs almost every week. It's been a remarkable performance since April. A lot of people didn't really believe S&P would actually make a new high back in May. It broke records after records throughout the past 3-4 months. And a lot of people were left out in the early phase of the rally, and now they are rushing in to chase performance, especially as we approach the end of the year. If the funds are behind the performance, they might get a bit more aggressive towards the end of the year. And what they typically do is not necessarily buy the things that have gone up a lot, hoping that they stretch further. They will start looking at things that have underperformed and rotating money into those. So what we typically see is that the indices are rallying. Investors hedge by buying some golds, buying some bonds we've seen more recently, and buying put options in the options market. But also they are picking names that previously lagged. For example, Apple and Tesla, which underperformed in this June-July period and started taking off in the past couple of months. And now you see things like Microsoft and Meta, which have underperformed in the past couple of months after the earnings report, and now starting to actually bounce again. So there is a lot of rotation going on in this bull market rather than being outright chased. And those who have been shorting the market have generally been burnt, and they would have been wise to stop out quite early because the trend is very strong. So this is a chart comparing gold's performance versus S&P 500. And this week, gold has reached a high of 4,000, which is a new milestone in the gold's history. And what we see is an accelerated pace of growth as well. So between 2020 and end of 2024, gold moved from 2,000 to nearly 3,000. And in the past 6 months, it moved from 3,000 to 4,000. So the pace of acceleration has increased. And that's not just due to emerging market central banks like People's Bank of China buying or the central banks from Brazil or India. It is also institutional investors from Europe and North America getting in on this trade as well. You can see that from very large positive inflows in the European and North American ETFs in the past couple of months. So everyone is now joining this party. What does they say about the general market condition? So first, yes, de-dollarization, institutional and supranational investors are trying to move away from a dollar-based investment strategy and moving into gold reserves instead. So that is a big part of the equation, where dollar has gone down year to date quite significantly, where gold has gone up. But there's also this mentality of using gold as a safe haven hedge, which has been a very typical trade, where if you worry about the market is beginning to crash, things are getting out of hand, the budget deficit is getting too large, and there's going to be a flood of liquidity and money printing in the foreseeable future, investors would consider buying some gold as a hedge, at least for the monetary debasement and hyperinflation. But there is a third component too. So ironically, gold actually benefits from higher liquidity. So generally, there is a 3 to 4 week lag between the rise in the global liquidity levels and global liquidity constitutes not just the simple M2 money supply, but also global collaterals, so high-grade national debts, FX swaps, etc. The increased levels from those driven by falling dollars, lower bond volatility, actually has a positive impact on gold prices. And you will see that in the very high liquidity periods, gold and S&P 500 tend to actually rally together. So on a daily level, their correlations are negative. So when stocks go up today, gold tend to go down. That's just correlation. But in the medium-term trend, they trend up together because liquidity is lifting all boats. And you will see later that Bitcoin also enjoys this liquidity, of course, but with a longer lag. So just looking back at historical rallies from gold, we see that gold rallied relentlessly after dot-com bubble into 2007, before the financial crisis. And actually, it went up even a little bit more because of the safe haven aspect of the trade as the stock market started rolling over. However, once the full crash is underway, there's a liquidity vacuum. So stock markets going down, volatility goes up, collateral levels are getting lower. The safe haven trade starts to evaporate because there is not enough money going around buying anything. And that's before the Fed starts to step in. So we see gold initially rushes even higher to the new high when the stock market rolls over, but also falls with the stock market afterwards. And again, this happened in 2011. Gold rallied after 2009 into 2011, just before the 1 decade bear market. And the stocks rallied with it and then rolled over just before gold peaked. Same thing in 2019, gold started rallying towards the end of 2018, and we had new all-time highs, the Fed cutting rates, but also a trade war just concluding between the US and China. And then we had the COVID stock market crash, gold went even higher, and then it went sideways afterwards. So the main concern here is that gold could actually go even higher from here in the next 6 months, possibly with a little consolidation and all that. But we could be faced with a big stock market crash. Maybe that's what the gold market is telling us in the not so distant future. Now, looking at the S&P 500 cycles, so this chart is using the past 3-year data to look at how the price behaves in a cyclical manner. So we use a selection of math formulas to detect the repeatable patterns in the price movement in the past 3 years. And this pink line here is the top cycle, the most dominant cycle, which lasts about 188 days. So this is quite a long-term cycle for SP 100, but we also combine the top 3 cycles we find from the past 3 years into this orange line here to see where how the S&P 500 behaves in the long term, but also in the short term. And we can generally see that we are in an upswing cycle since August with the dominant cycle, and this could peak at around end of the year. And one thing you need to watch for is that the absolute length of this cycles chart doesn't mean the absolute movements of the price. It's just a behavior trend where you see if the cycle is going down, the path of least resistance for the price is probably going downwards, and you see this moving up with a bounce in the SP 100, SP 500, and then the market rolled again with the cycle going down. So it's not this, the absolute strength is not 1 for 1, but it gives us a sense of direction of where things are on a cyclical basis. And again, on any given day, the market can behave in a random fashion. But we are just trying to pick out historical patterns from the raw price behavior. This is another lens of looking at the S&P 500. So on the top, we have the 50-day moving average as the main trend line for a bullish versus bearish state. So above the 50-day moving average, generally we are in a bullish pattern, and below the 50-day, the market is seen as being bearish. And the different colors suggest a different volatility regime. So above the 75th percentile, we really see the volatility regime being quite volatile, and we mark that in red or blue, depending on whether the price is above or below the 50-day. And below the 75th percentile of the past 1 year, then we see the market as a calm state. And since May, the market has been very calm, and if you can see that volatility has actually been declining a lot, and now we're actually well below the 50th percentile, so below the median of the past 1 year. So the market is really climbing up very steadily with very little drawdown, very little volatility. And at some point, this will snap. It can't go on forever, but it has been extremely difficult for investors to fade this move. And I do think that when the time to start panicking is when this volatility starts to spiking up, and when the 50-day moving average is breached, and then we can get much more sensitive. We're going to step on the sidelines and reassess the situation and see when the market can get calm again. But it's quite nice to use this almost like a trading stop. Now, looking at bonds, the bonds also behave in a cyclical pattern, even though the past 3 years have seen a wide range of sideways action for bonds. And what we see is that treasuries are in a upward swing in terms of a cycle, which doesn't top until early November to early December. So for me, this suggests, given the past cyclical patterns, the path of least resistance for bonds is still higher. And once we get into the year end, things may start looking a bit more bearish for the bond investors. And just to clarify, in bond terms, bullish means yields go down, prices going up, and bearish means prices going down and yields going up. And now moving on to Bitcoin. So Bitcoin actually behaves in a quite predictable long-term pattern. And we are starting with 2024. That's when the IBIT ETF started. So the institutional investors really had a proper gateway to trading Bitcoin spot levels rather than futures. And what we see is that Bitcoin tends to lag gold in its price movement by about 2 months. It's not exactly 2 months. There'll be a few days difference at the turning points, but generally speaking, 2 months is the lag. And this goes back to what I said earlier about global liquidity, because liquidity flows into gold first within 3-4 weeks, and then Bitcoin afterwards with another 2-month lag. So what we see is that when gold was starting to take off in July 2024, Bitcoin bottomed around end of August, beginning of September. And then gold started to consolidate and moving sideways in late October, early November, and we saw Bitcoin topping at the end of last year and beginning of this year. And again, gold started rallying from January onwards. Bitcoin almost bottoming in March, but probably bottoming in April. There was a little bit more lag, but it managed to catch up in terms of rally. Again, in May, gold started to move sideways. Bitcoin started moving sideways in July, forming a topping pattern. And more recently, gold bottomed at the end of July, but really probably started moving in August. And we see Bitcoin having this strong bounce at the end of September. We could maybe consolidate a little bit longer and then start moving in late October, early November. So if you look at those charts, it suddenly becomes very clear that in the short term, Bitcoin and gold move oppositely in terms of a correlation. But in the medium term, Bitcoin is following gold's trajectory due to the liquidity factors. So now, looking at yesterday's session, what we saw was that after the market open, so this is only the intraday data after the open, and we're looking at the cumulative returns since the market open. SPY, QQQ both did pretty poorly, but flattish during the day. Bonds was just dead flat throughout the session. Gold, Bitcoin, and oil all went down together. So there has been a generally risk-off sentiment, but also you can sense that this could be a liquidity play because normally gold would rally when stocks are down or Bitcoin is down on the daily level, but at the moment, gold is moving down with everything else as well. At the same time, Max 7 stocks, Apple and Google both did pretty poorly yesterday after the market open. But what stood out to me was Meta. So Meta had performed very poorly in the past 2 months. It had, after the last set of earnings, it shot up within the next day, but it just moved sideways and generally downwards after that. However, I think recently we did probably reach a bottom this week, and there has been strong investor appetite coming back into the market for Meta, as you can see, while everything else was going lower. Now looking at SPY, SP 500 ETF, I've hardly ever needed to change my chart analysis since probably September. This trend line has been extremely resilient, tested 5 times now, and with exception of this one false breakdown in September due to non-farm payrolls, we've been above it. So below this trend line, I will start thinking about maybe wave 4, but we've not really had tested that. And as the price is going up, getting more stretched, I think more investors actually waiting for the dip, but they will rush in to buy the dip quite early. So I do think when it falls, this 50-day moving average could very well catch the bottom. And if not, I do think around 630 level is probably, so where this large volume profile is built will be a very resilient support here. QQQ also moving very smoothly within a quite narrow upward channel. And as you can see before, it could just move alongside this upper channel for a long time before having a small correction. And what we see is that this wave 3 is at the 1.76 extension of this wave 1. And falling, if we do get the correction, the 50-day is right at the bottom of the channel. So that is a very strong first support. And if we breach that, I suspect we'll catch the bottom somewhere in the 560s region with this heavy volume support here. And you have to understand investor psychology in this bull market. Everyone's a little bit scared of getting in at the highs, but as soon as the dip starts to happen, they don't want to miss out. So we get something like a 7% dip, which will actually be considered quite big dip, given the smooth volatility we've enjoyed in the past 6 months. A lot of investors probably won't wait for the full 10% before they buy. i.e. they're trying to front run each other. And I suspect this will happen at some point in the next couple of months, because historically, when S&P 500 goes up 5 months in a row, we tend to get a little setback either this month or next month. So I've no doubt we will get a pullback, but I don't think the pullback will be atrocious unless you're leveraged, which is probably not a wise thing in this market. So looking at bonds, as we broke above this long-term resistance, we are now looking at a breakout retest and then wave 5 higher of this large degree wave 3, which heads towards 92. And I am quite comfortable with those levels and this thesis. You can see that from May onwards, we are seeing an upward trend that's now starting to accelerate. And we've just enjoyed a golden cross here with the 50-day in blue, cross above the 200-day in red. So typically that is a bullish technical sign for bonds. And the US Treasury has managed to massage the bond prices through decreasing the duration of its issuances, so not to spook the long-term bond market, but rather focusing on refinancing at the short end. And I do think that makes sense if they can get away with it as much as they can, because you don't really want to issue bonds, i.e. borrow money at the historical high levels of 5%. When I say historical, I mean the past 10, 15 years, of course. Looking at oil, we've been in a fairly tight range with lower lows and this 71, 72 region being a heavily contested support. And things do look a bit more bearish now. We could have a breakout below here. So I think we need to wait for the breakout for confirmation. But there is a very thin volume in this region here. It could gap up all the way down below 70. That will be our wave 3 target near the high 60s. So just zooming out, I do think now we're likely to be in the 5 waves down for this final large degree wave C. And that would actually conform with the fundamentals where there's simply too much supply coming to the market from OPEC and non-OPEC countries versus the lack of demand. And with China going very much electric in the past couple of years, that's really upset the oil prices. And the near term, the reason it's actually holding so big in the near term at 70 is that investors are just worried about the supply chain shock. If there's something happening in the Middle East, Israel, Iran, or Russia and Ukraine, where heavier sanctions can disrupt the supply. Moving to the crowd favorites, Bitcoin. So combining what we said earlier, I wasn't surprised that we were testing a little deeper in this wave 4. Generally speaking, wave 4s tend to test the 0.236 to the 0.38 retrace of this wave 3. So I did think that testing 119, 120 is absolutely normal for Bitcoin right now. Now, can we get an impulsive wave 5 higher imminently? As you saw earlier in the correlation chart with gold, when gold started rallying back in August, we are probably coming towards that rallying time now, towards second half of October. So in the near term, I think we could consolidate a little bit. And I do think we'll see a new all-time high towards 130 or even higher in the next 2-3 months before the year end. Ether has been more tricky because this was a very well contested ceiling resistance area for Ether, and it's been tested 4 times now, including the initial top, and Ether just couldn't get enough momentum behind it for a full breakout. And typically Ether moves slightly behind Bitcoin by 3-4 weeks, again because of that liquidity factor So I think in the near term, there is actually room for Ether to just test a little bit lower in towards 4,000 to 4,200. That would form a wave one to set up, which I haven't marked here, before a decisive breakthrough in wave three, and then retest in wave four, and then wave five higher towards the 6,000. So that is my current expectation on potentially how this path could play out. And if I just draw it here, it will look like something like this. So of course, these are placeholder levels until we get the full wave two set up. We can't project those as accurately as we like, but once we have this wave two ended, we can start thinking about the most precise levels of wave three. Solana. So Solana is not quite in the same league as Bitcoin and Ether. And if you look at Coinbase trading volumes, Solana and Ripple actually swap the third places quite often. It doesn't quite have the same institutional interest. It doesn't have a spot ETF that's quite clean for investors to invest, and BlackRock hasn't filed for anything yet. And we have seen the spotlight more being stolen by the Bitcoin and Ether treasury companies in the recent month. For me, this wave five top from earlier in the year will be a significant source of resistance. We still haven't quite reached there yet. And what I'm worried about is that this wave three that initially I thought could extend much further is only slightly beyond the 100% extension of this wave one. And in the Elliott wave theory framework, this could easily be an ABC corrective bounce as well. And this could be the top. But given what I see across the pond in Bitcoin Ether and with the seasonality towards the year end, I don't really expect this to be the wave C top, but I'm putting this option out there just so you have both the bullish and the bearish argument. And I do think if this is an ending diagonal where wave four could overlap with wave one, this wave four could test even lower towards the 200-day moving average. We're not there yet. This lower boundary of the upward channel has been well protected, been tested 4 times, it hasn't broken down. But if it breaks, I think the 200-day moving average is a very obvious source of the pullback zone. The reason I think this could be a wave three top rather than having the wave three much higher and this being like a 1, 2, 3, 4, 5 rally is because this retrace here has pulled back below this top here. And you could argue that in commodities and Bitcoin, more volatile assets, this happens more often. But generally speaking, in wave threes, we wouldn't really want to see the subwaves overlapping between wave one and wave four. So that's why I'm tentatively putting a wave three here. But if we get more information, much more bullish pattern from onwards, I can reassess this structure. Coinbase, interestingly, Coinbase has been a bit more bullish than Bitcoin and Ether. Usually Coinbase moves with Bitcoin and Ether, but this time it has managed to stay quite bid near the local highs when Bitcoin and Ether retraced. However, I do think it would be better to wait for a pullback towards the 330s for targeting this wave three entry. That's assuming you haven't got in already, because our signals has turned positive from end of September. So that our signals would have caught this move up. But if you are more of a technical trader, you're looking for signs of a breakout and then buying on the retest, I do think 330 is a good level to for pullback if we get one here. So that's the 0.618 extension retrace of this initial wave, and we can think about how far this wave three can get once we get this pullback. But generally speaking, I do expect this larger degree wave five to come with a new all-time high and probably in the 500 region. So Robinhood has been so bullish that it exceeded my initial wave 5 target. And so we're looking for clues on where it could end. So in earlier wave theory, wave 5 could replicate the length of wave 1. So from April 7th low to end of April, this run here. And if we move this across, that would point to a termination zone in the 160th region. So I would say even going between 160 and 180, we're still feasibly in this wave 5 territory. But if it's moving even higher, I'll have to reassess whether we are more in an extended wave 3 before we see the final wave 5. Gold, this parabolic rally has well exceeded my initial expectation for wave 3, even though we identified our wave 3 already back in July and August. Where can this pullback go? So typically wave 4 again is the 0.236 to 0.382 pullback. So 340 to 350 is and if we're looking for a steeper pullback, this volume profile here at the 50% retrace serves as a backstop, I believe. It's hard for me to see the immediate pullback to challenge below 330. Let's put it that way. So Apple has all but met my wave 5 target, which is just under 260. So I think we could see a more immediate pullback now, especially if the broader market pulls back, or at least money taking profit from Apple. If you look at where we are now, we are at the December high, and it's perfectly normal for a wave 4 retrace that would form a classic cup and handle pattern before a new high in wave 5. And the retrace, I suspect we could target somewhere in the 230 to 240 region. So we have the 50-day moving average here as a first support with a heavy volume profile over here. So it's hard for me to see Apple going below 230 in this pullback, especially that this wave 2 was pretty steep. So I do expect wave 4 to be shallower. But overall, this bullish run has more or less completed its course. So chasing here would not be great risk reward. Amazon. So I am now fairly confident after yesterday's price action that we are starting wave 5 here. There was a heavy volume profile being built in this bottoming region. We've had 5 waves down in this wave C. So everything looks pretty pitch perfect for the next rally. And the next rally could target 250 above. In terms of valuation, our growth adjusted basis, Amazon is behind NVIDIA, Google, and Meta. So I understand that a lot of people think Amazon is very cheap, but you have to think about Amazon as 2 separate entities, the AWS, the high margin business, versus e-commerce, very low margin business with much smaller growth. What could accelerate Amazon going to this earning is we see a pickup in the speed of growth of AWS. Google for me looks like wave C of this wave 4, which could challenge just below 230. I was never really that convinced that we bottomed here because of how shallow this was as a correction. And this B wave bounce stopped short of the wave 3 high. So I think near term, there is room to come back into this channel from the April low and retest the 50-day moving average. This moving average obviously will also start moving up towards our target region as well in the meantime. So Meta bottomed right at the VWAP since the April low. And we found an intraday bounce on Monday. And now we're seeing quite heavy interest, especially a counter wider trend rally in Meta on Thursday towards the 50-day moving average. So I'm getting a bit hopeful that we are starting wave 5 now. So this looks like the bottom being in, largely at the 123 extension of this wave A. And now thinking about wave 5, I would say as a basic expectation is that wave 5 tends to be anywhere above the 1.38 extension of this wave 4. So the inverse extension of this wave 4. And alternatively, it could be the same length as the wave 1 as well. So, but this is forming my basic expectation that Meta should challenge 840 region by the end of the year. Microsoft, the shape of this rally doesn't look extremely bullish, and it topped just under the 100% extension of this wave A. So I'm putting this as wave C top for this wave B, and we are seeing the market starting to roll over in the past week. There is still this 50-day and heavy volume profiles as a first support. So I want to see how it interacts with this region. If we break down, then we're getting quite confident we are headed towards a much lower low in wave C towards 470. And in grand scheme of things, this wave C is actually not that bad given how fast and how much Microsoft rallied after the April earnings. NVDA, so up until this week, I was quite tentative on whether this rally was a wave B rally, but now we've solved the puzzle. We're definitely in the wave 3 of 5, large degree wave 5, which will come with probably a target region of 200 plus. So currently this wave 3 is still progressing, is at the 1.38 extension of this wave 1, but could easily challenge 200 mark, which is the 1.76 extension. Tesla, the price action hasn't been encouraging in the past week, and my sense is that the stock wants to retest the 400 mark before the next leg higher. And obviously, if you look at proportionality wise, this wave C could even dip below 400 and into 390 region. But my base expectation is we're going to hold above 390. The wave 2 pullback was pretty steep in this initial rally. So I can't really see wave 4 being a very steep one as well. And wave 5 should challenge 500 above. And we could resolve this pretty soon going into the earnings. Palantir, to me, this wave 4 was complete. It had sufficient length at least. And we could be moving towards wave 5 high above 200. And this, again, is in the classical technical analysis. This is a cup and handle pattern where it challenges the prior high, pulls back retest, and then move higher after. Finally, SOXX. It's really hard to preempt the top in this one because this was very extended, but it just went on very aggressively. And I think just below 50-day moving average has very strong support in terms of volume profile. So if it does start to pull back, this will be my target region. And I don't think this is the top. I think there will be a lot of buying interest again over here, aiming for one more high. So that's it for the week. Thank you very much, and see you next week.